Hi, this project is an evidence-first triage prototype for trade-based money laundering review. Its purpose is to use annual public trade data to decide which unusual pattern an analyst might review first and make the reason for that priority visible. It does not identify a criminal transaction, customer, or counterparty. I will begin with the practical problem this queue is designed to solve. Trade-based money laundering can involve price, quantity, or goods description manipulation, but a bank does not see the complete trade chain and public data does not contain the facts needed for a decision. The immediate problem is therefore prioritization. Which patterns deserve limited analyst time, and can we show why? Before following the pipeline, I want to define exactly what the project analyzes. The project analyzes three commodities, which are the crude palm oil, refined copper cathodes, and non-monetary unrolled gold. The three commodities were chosen to test the method from both sides. Gold is the stress case, high value and volatile prices, so genuinely unusual trade must still be caught. On the other hand, both copper and palm oil are well benchmarked commodities where the method must stay disciplined and not flag ordinary trade as unusual. The commodity itself is never treated as suspicious. Why it matters? The practical change is in the starting question. Instead of receiving a score and asking why does this alert exist, the analyst starts with which clearly stated facts should I verify first. This reduces reconstruction work without removing judgment. How the queue is built. It started off with public data, combined several unusual pattern signals into a ranking, attached recomputable evidence and caveats, and sent the result to a person. No individual signal makes the decision, and the process ends with a human review. To trust that queue, we first need to understand the role of the data sources, the unit of analysis, and how the data is prepared for analytics ready. The dataset contains about 25,000 official observations across 8 years and 3 product families. Of these, 91.5% have the valid positive value and quantity needed for unit value scoring. Those eligible rows still represent 99% of reported trade values. The sources have separate roles. CEPII supplies annual bilateral trade value and quantity. World Bank commodity prices provide broad same-year market context, and FATF publication contribute to typology language, caveat, and review question. It is not used in model input or as a row-level evidence or proof of money laundering. So what does one row represent? The row shown here is the annual total for one exporter-importer product year. It is not an invoice, shipment, customer, payment, or confirmed case. That distinction is the boundary for everything that follows. In the preparation of the data, we first need to verify the source and the expected fields. And then we have to standardize the trade value to US dollars and the quantity to metric tons. Following that, we then can create one traceable annual row and exclude row without usable quantity from modeling while retaining them for audit purpose. Then we can also create time-safe analytical signal. So what do I mean by time-safe analytical signal? It is basically no peeking into the future. For the 2021 example, earlier years can help describe the route's history. And 2021 peers and market context can be used, but 2022 onwards remain hidden. The derived signals then can ask whether route change against its own path, its same year peers, the broad market, its value versus quantity movement, or its activity history. For context, these are the derived time-safe analytical signal. Each signal is a measurement, not a verdict. Now that the rows are comparable, I would like to explain three analyses found in the data, which are the market scale, price movement, and review priority profile. Across the full dataset, reported trade value is about 3.52 trillion. Gold carries roughly 81% of it. That tells us where the money is, but not where the unusual behavior is. Each product panel has its own vertical scale, so the height should not be compared directly. Toggling to quantity also shows why value and physical volume tell different stories across gold, copper, and palm oil. Here I have also provided with the annual scale data for the trade value and quantity across the years in each product family. Trade value can also rise simply because the whole commodity become more expensive. These lines are world commodity prices per metric ton, not the amount of money traded. If palm oil, copper, and gold rises across the whole market, an individual corridor may rise for an ordinary reason. The method therefore asks not only whether the corridor moved, but whether it moved differently from its commodity benchmark. The benchmark is context. It is not an invoice price or fair value reference. With scale and market movement separated, the final section describes the Q profile produced by the dataset. The top 50 is distributed across all three families and 7 years. In the current run, 2022 contributes 16 cases. Gold and palm oil contribute 18 each, and copper contributes 14. These counts describe the selected Q, not the frequency of misconduct and not the relative risk of a commodity. I will now move on to the official records and analysts can actually work through. This is the live output. Every row is a real official annual observation, ordered by review priority score. The filters allow analysts to scope by year, product, exporter, and importer. The score combines several unusual pattern signals. A higher value means to review earlier. It is not the estimated probability of a financial crime. The table keeps the facts needed to orient the review, which are the route, these are the route, product, annual trade value, quantity, unit value, which is derived from the total trade value divided by the quantity in metric ton, as well as the benchmark price. Right? Rank alone is not useful enough, so I will open one case and show how the evidence reconstruct the reason for review. So now I have selected the first rank. This is the selected case review. The selected case is the 2022 Spain to Netherlands gold observation. It reports about 11.8 million over 0.03 metric ton, which implies about 370 million per metric ton. That is 6.4 times the 2022 World Bank gold benchmark and 8.4 times the median of this corridor's 5 earlier observed years. The peer view asks a different question. How does this compare with every same product corridor in 2022? This case is at the 99.4th percentile among the 1,400 unique gold corridors in the dataset. Well, 22 peers are at least 3 times the benchmark, so it is not the only extreme, but it sits near the far end of the full population. These are the 3 contextual comparison, not 3 finding or mispricing. I've also provided the table view for easy comparison. And corridors are defined as a single exporter-importer trade route. As can be seen here, the year 2022 is at the peak of the benchmark multiple. Right. 4 evidence checks are published for this case. Its implied unit value rose sharply from the prior active years. It sits far above the annual benchmark, it breaks from the corridor's earlier range, and its benchmark relative gap widened. The evidence table records the metric, comparison group, observed value, source field, and caveat. The key point here is the convergence. Several independent comparisons move in the same direction, which supports reviewing this case before those lower rank rows. However, none of that establish why the aggregate changed, because product purity, contract timing, insurance, commercial terms, or reporting these differences are not taken into account in this evidence ranking. The case-specific caveat explains that short or very stable history can make the deviation metric sensitive. Annual movements may reflect ordinary commercial differences, and the benchmark is a broad market context. The project-wide limits are even more important. These are annual country totals with no invoices, shipments, customers, payment, ownership, or product grade details. Therefore, human review with private evidence is required before making any conclusion. Having seen the output and its evidence, the next question is whether the ranking method behaved as intended on data where we know what was planted. So, public data has no confirmed crime label. So, the project does not pretend that ordinary rows are innocent or that a model can learn real machine learning outcomes. Instead, it creates a separate test copy and plants controlled patterns, which are overvaluation, undervaluation, low volume, or high value cases. It also plants benign lookalikes, including market aligned move and proportional value and quantity growth, which the method should leave alone. The machine learning model is fitted in 2017 to 2022, evaluated on 2021 to 2022, and tested on 2023 to 2024. This separation prevents data leakage, and test rows never enter the official queue. On 6,000 eligible test rows containing about 108 planted patterns, the selected method placed 24 planted patterns in its top 50. That is 48% precision and 22% recall rate. Random selection will be expected to find about 0.9 planted pattern, so the queue is 26.8 times more concentrated than random. These figures measure this fixed synthetic test design. They are not real-world detection rates. So the chosen ranking combines two views. A weighted sum score applies fixed inspectable weights on important signal. SGBoost learned the nonlinear combination of those signals from the planted training scenarios. 3 different weight percentage were compared on validation data. Right. and 75% XGBoost plus 25% weighted sum rank the most planted patterns among those permitted hybrid model. The 25% here is a formula weight. It's not a percentage of human judgment and not a claim that the whole hybrid model is transparent. The weighted sum component also subtract score when the movement follow the broad market and reduces a score when supporting data quality is weaker. After those adjustments, the weighted score is clipped to 0 to 1 before modeling. On the held out test, the standalone XGBoost scored slightly higher than the hybrid. However, the hybrid remains because the design required an auditable weighted component before the test is conclusive. That is a governance choice, not a claim that the hybrid model won on test accuracy alone. Finally, the ranking system suggests a row scores highly because several signals are unusual, and we may not say the model detected money laundering or that the World Bank benchmark proved mispricing. This method only works when both value and quantity are usable, meaning those are reported. The next page makes the excluded records visible rather than turning missing data into suspicion, which were the records of data that was kept for audit purpose, right? So here, as mentioned earlier, unit value scoring needs both value and quantity. Hence, we can compute the unit value and derive all the other signal matrices. Gold has about 1,800 records without usable quantity, which is 15% of gold records. Yet, those records carry only less than 0.1% of reported gold value. So 99.9% of gold value remains accessible. That is reassuring on the financial coverage. But the frequency creates another question. Why can nearly 1 in 6 gold records not be evaluated? This is a scoring blind spot, meaning unavailable assessment, not hidden risk or missed case. The next section asks whether the excluded value is broad or driven by a number of patterns. The 1.183 billion excluded trade value is highly concentrated. One 2024 United Arab Emirates to Thailand record is about 830 million or 70.9% of the gold gap value, but only 0.03% of the entire all of the gold value. The route has usable quantity in its other 7 years, so this looks like a one record exception to trace. A different pattern appears in 14 of the 702 gold routes present in old 8 years. Quantity is unusable in every single year. Together, those routes carry only about 1 million, which is insignificant comparing to the entire trade value. Their significance is repetition, not financial size. They belong in a data quality review, not the anomaly queue. Because the repeated group is so narrow, the network can give data owners a more practical place to begin tracing it. Right. The next section here, 12 of the 14 recurring route touch Netherlands. 9 run from it and 3 run to it. Greece, Ireland, and Latvia appear in both directions. So the area of the circle show how many of these routes are connected, while arrows show exporter to important direction. And this concentration gives data owners a practical starting point for tracing source or processing rules. It does not identify which reporting party causing the missing quantity, and it is not a country risk signal, but the correct action is to keep incomplete rows outside of unit value scoring or modeling, trace the recurring routes, and monitor those record coverage separately from value coverage. The public data prototype can now prioritize what it can assess and disclose what it cannot. The final business question is what a bank will add to make a case reviewable. Everything on this page is future state design. Private bank data integration, case management connectivity, and production decision have not been built. The proposed rule is an external intelligence input at the front of an existing anti-financial crime case review. Today, the prototype combines public trade data, market context, a brand queue, and evidence. In a bank integrated design, that public signal would enter the existing workflow, relevant customer, document, shipment, payment, and ownership records will be joined, and an analyst will decide what the combined evidence means. Completed review outcomes could support later evaluation only after quality and bias checks. The visible product remains the case queue. The proposed extension adds governance layer evidence around that queue. It does not replace it with an autonomous decision engine. So a bank will add 6 kinds of evidence: know your customer and expected activity, contracts and invoices, shipment and custom records, payment and the correspondent data, sanction, adverse media result, and even beneficial ownership. These records let the investigator ask whether the parties, goods, value, quantity, movement, and payment tell a consistent story. So where AI could help? AI could add value by connecting approved records that sit across systems, comparing names, dates, quantities, price, terms, and payment, and laying out what matches, conflict, or remain missing. The useful output is not a generic prose, it is a source link case, packed timeline, relationship view, and set of unanswered questions. The assistant would use only records the analyst can access, cite every factual claim, say when the records do not answer question, and can keep an audit log. It would not decide suspicion or the next action. That combination could focus analyst time, test a public signal against bank fact, start the review with evidence rather than a bare score, and use the quality controlled outcomes to evaluate the queue later. The decision is still remains with the human. So this is like a mock-up product that I've created, right? So the last section is the data dictionary. The appendix is the audit trail behind the language used throughout the dashboard. So this is where we can search for the definition of the signal or certain metrics used. And these are the official data sources along with its URL. Hence, I would like to close off by saying the prototype's contribution is not an automated verdict. It is a more disciplined start to human review, prioritize patterns, traceable evidence, explicit caveats, and a clear path to the bank records needed for a human decision. Thank you very much.